Good Saturday to you folks. Now, you notice I've changed it. I didn't want to say hey y'all like I normally do, or hey guys. Um, believe it or not, is the second take of this video. Reason why? I recorded it last night and it was over 30 minutes long. And I'm like, there's no way anybody's going to watch this. So I'm going to try to get through my points as quickly as possible this time around. Hopefully, I don't stumble and all that like I normally do. And here I am wasting a minute talking about how I'm going to redo this. So if you're new here, please like, share, subscribe, do all that good stuff. Down in the comment down below is ways you can support the channel. Did you know M1 Finance? With the link down below, you can get $50 by opening up a brand new account. They just keep raising this. It started out at $10. Now it's 30. Then it was 30. Now it's 50. It's a great deal. If you've been planning on opening up a account for your son, your brother, your mother, your son's brother's mother, whatever. It's a great opportunity if you like the M1 Finance platform to get $50 for you, $50 for me, just by using the link. So if you don't have an account at M1, please consider using my link. I'd appreciate it. So what are we talking about today? Today we're talking about YYY. Why? Because that's what we do here on the GW ETF channel. We look at income funds, income ETFs, income closed-end funds, income generation from options, talk about retirement, things of that nature. So glad to have you. Now let's jump in, and I'll try to make it as short as possible. So YYY, this is brought to you by the same people that brought you Devo. If you're not familiar with Devo, I'll link above and below the video to that. It's a covered call ETF, so it's the same ETF managers. Now YYY is the AMPLIFY High Income ETF. It is a portfolio of 30 closed-end funds based on a rules-based index, and we'll go through that index real quick, the mythology of it and how they rank them. But I'm just going to rush through this right now. So data as of June 30th, distribution yield of about 8.8%. And distribution frequency, monthly. Currently, let me refresh this. Let's see if that... okay, it's still data as of July 8th, 17.55. I think it gained 10 cents today. Today's Friday. So 17.55 a share. We'll go over here to the left and look at it. Average CEF discount is 4.73%. Now, if you don't understand that, closed-end funds are mainly income vehicles, mostly owned by retirees. Now, the way closed-end funds work is an asset manager assembles a portfolio and issues shares. Now, those shares are bought and sold on the market, but the price of the shares are commanded by supply and demand. It's not set like the assets, the value of all the assets, like a normal ETF would be, but a closed-end fund, say the asset managers have all the assets in the fund add up to $20. You could potentially pick that up at a discount, say at $19. So theoretically, you'll be paying $19 for a portfolio that's worth $20. But it can also work vice versa as well. You can pay $21 for a portfolio that is worth $20 a share. Hope that makes sense. Just the price is disconnected, and it's only it's priced by supply and demand on the retail market, because the vast majority of people that own these are individuals, not hedge funds and things like that. So let's see, we got $455 million in net assets, so $455 million in the ETF fund. The fee for the ETF is 0.50. Now that might sound a little high, and it's kind of not, considering the complexity of some of these, or the thematic event. The themed ETFs are normally higher. If they're just following a basic index like the S&P 500, it's easier for them to charge a lower fee. Now, one thing important to keep in mind about this one is the acquired fund fees and expenses, which is 1.95%. Since this is an ETF that holds funds, so it's a fund of funds, you take on the expenses of the funds that the ETF buys, right? So in all, from all their purchases, they took on the fees of 30 closed-end funds, and that equals 1.95%. Now, those closed-end funds, they have management expenses, and some of them have interest expenses, because a lot of them use leverage or loans or preferred shares to try and boost the income of the closed-end fund, and to produce income for retirees, because that's really what these are made for. So a total expense ratio of 2.45. Now I'll go through the holdings on another page. Now, what this thing does, and this is why you would want to own this one, is because you'll get diversity in the closed-end fund space. If you're not going to, or you don't have the time, or you don't want to put in the effort to research the closed-end fund space, and find those opportunities to buy, then buying something like this probably makes sense, even with the added expense, right? Because with this one purchase, you get exposure to high yield bond funds, loan participation, which I believe is like mortgage-backed securities, multi-sector bond funds. So multi-sector meaning corporate, government, international, things like that. General equity funds. They also have closed-end funds that just own stocks. Equity tax advantage funds. That could be even municipal bonds, those type of things. Hybrid balance funds, which is stock and bond type portfolios. Energy, natural resources, covered call funds, convertible funds, limited duration bond funds, emerging market income, and global real estate, REIT, and real assets. So with this one purchase, you end up buying a complete basket, and you get exposure to a lot of different sectors or asset classes with one buy. So the top 5 weights of CEF issuers are some pretty well-known names: Eaton Vance, Invesco, BlackRock. And since inception, there's an asterisk there, and I don't like asterisk, but looks like year to date they're up about 16%. Annualized since inception, 7.65%. So not horrible. So next we'll jump over to the summary prospectus, and I just want to go over real quick. I think this is where I wasted a lot of time last video, but I wanted to show you how they pick which closed-end funds to buy. So eligible constituents must have a market cap of at least $500 million. And then they are ranked as follows. They are ranked by fund yield, the total income returned of a fund, which takes into account all distributions, let me zoom in, made by a closed-end fund, including return of capital, with funds with larger fund yields ranked more highly. Number 2, and I think this one is more important, by share price premium to discount to net asset value. That's what I was speaking of earlier. On the index rebalancing date, with funds with a premium or smaller discount ranked more highly than those with a larger discount. Now, you might want to say, if you read that a couple of times, it doesn't make sense. Why would you wait or buy heavier into funds that are trading at a premium or at a smaller discount, right? Why would they rank higher? The point is, actually, if you think about it in this way, if a fund is trading at a premium or a very small discount, it typically trades that way, like on average, that would mean to me, or that could mean to you, a very high quality portfolio, or at least a high quality demand, right? At least that the people that are investing in it demand a certain price for that fund. In other words, they think the managers are high quality. That's what it means. And usually the ones with a larger discount usually there might be some issues there, right? They might have made some bad decisions. They might have cut their distribution, things like that. So not all the time is a larger discount to net asset value a good thing. So you really have to think about it. There's sometimes, if you can get one of those that trade at a premium, like perpetually, they always trade at a premium, and then all of a sudden, just for some odd reason, they trade at a discount, like say March 2020, you could have gotten a lot of excellent funds at a discount to their net asset value. And a lot of those shot right back up right after April. So that goes with a lot of things, but closed-end funds, especially ones that use leverage, can really drop when the market does. So right here are the holdings. I'm going to just slowly go down them. You can check them out. You can pause. There's quite a few in here that I'd like to do videos on, but we'll probably get to that in the future as I dig through them. So if you want to look at those, there you are. Now, one thing you want to do when you're talking about closed-end funds and you're talking about generating income, how's it taxed, right? And the good thing about AMPLIFY ETFs, they actually give you tax information right here. We'll click on that. Let me close those because I already looked. And when you're looking for tax information, you don't want to rely on this form. This is Form 19A1. We'll click on one of those. And it says notification of source of distributions. Now, what this is saying is some of the distribution of return of capital. Is it short-term capital gains? Is it long-term capital gains? Is it qualified dividends? All that. So do not rely on these if that's all you can find. Reach out to the ETF issuer and see if you can find a Form 8937 for the previous year. Why? Because this is, it says current distribution 8 cents, estimated return of capital 31%. Now, this is important. It's estimated, so you don't really know what's going to happen until the end of the year, like it says right here. As a result, shareholders should not use this information provided in this notice for tax reporting purposes. So look for the Form 8937, and you'll be able to see. You can look at the history of it, and we'll just click on one. And this is, you'll get a Form 8937 if the fund you are investing in is paying return of capital, because they need to report to the Treasury, to the IRS, that essentially part of the distribution is considered a return of capital, and you cannot be taxed on that. But what's supposed to happen is your cost basis of your shares are supposed to be reduced by that amount. Who keeps track of that? That's still a mystery. Hopefully somebody will come along and answer that one of these days. But you'll see at the end of the day, in 2020, year 2020, AMPLIFY ETF paid out basically 53% return of capital. So 53% of the distribution you received ended up being a non-dividend distribution, and that'll be reported as such. So it doesn't even actually get reported on your tax return. And I think I got it. I think that's it, guys. Got to the holdings. So who do I think should be buying this? It's hard for me to say. I guess because I'm biased, because I would just go out and find a closed-end fund that I like and buy it instead of a basket of them. But this isn't a horrible investment. I don't think it's a great investment. You got fees on top of fees. That's, you got a 0.5% ETF fee on top of all the fund fees and interest expense that the fund holds, from all the closed-end funds. So to me, that's a double whammy. If you look at AMPLIFY, we'll look at it real quick. I was looking at some other stuff here. Dividends have been they've been spotty but steady. Okay. Because if we look here, back in 2016, they were paying $16. That'd be nice. They'd be paying 16 cents a month, and then they dropped it down to 13 cents a month. This is an anomaly. I don't even think that happened. But they've been sticking with 13 cents for the past 5 years. Will they continue it? I don't know. They got a 5-year track record of keeping it 13 cents, so there's a good chance that it will. So what do I think? I think if you don't want to invest the time in finding a closed-end fund and you want to be exposed to those exposures allocations that I was talking about, treasury bonds, convertible securities, mortgage-backed securities, bond funds, all that good stuff. If you want a super diverse allocation in one buy, then this one could fit. You know what I mean? But to each its own. It's a little high on the expense ratio for me, a little spotty on the distributions. But let's take a look at how it performed. And I'm going to compare this over the last year to an equity ETF that is paying about the same distribution yield, around 8%. And I was actually surprised at the results here. I really am. And I'm going to compare YYY to JEPI, right? So let's take a look. We're just going to max it out because JEPI's only been around about a year and a few months. And we'll chart 10,000 invested. So let's take a look here. Now we'll see YYY ever since May of 2020 returned 41.91%. for an average annual total return of 96.25%. That's about a year, about 13 months. And JEPI, on the other hand, total return 33.86% with an average annual total return of 29.4. So interesting that YYY has outperformed JEPI. It actually it kind of shocks me, but I think long term, I still think JEPI would be the better spot. I just think there's a lot more upside to JEPI than there is to YYY. Why? It's just my opinion, and I'm entitled to it. So you're entitled to your opinion, and you guys can, comment down below, leave your opinion down below. I'd appreciate it. So if you like, please like, share, subscribe, do all that good stuff. Check out M1 Finance. You're getting $50 now instead of 30. Check out my Amazon link. If you're Amazon shopper, shop there. I appreciate it. My Ko-Fi link. A lot of you have used that on my last video. I truly appreciate that. It's all going to go into that GWRV fund. And next thing you know, in 5 to 10 years or however long it takes, we're going to be making videos inside an RV somewhere down the road. And stick around and we'll get there. So I appreciate all you guys. Hope you guys have a great weekend. Hope this didn't get to 30 minutes like my last one did. You guys have a great weekend. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. please seek a licensed professional for any investment, tax, or legal advice. Thank you.